Hey, so the Fed's about to rug pull us, and what happened in Japan might happen again. But I wanted to thank you for 2 mil subs. Y'all are amazing and mean the world to me. Thank you so much. Now let's get into the world ending.
Could there be another wave of the collapse of the Japanese stock market that takes the entire global economy with it? Much like the stock market on a Monday in the United States, where we had Jim Cramer freaking out and pretty much everyone on Wall Street freaking out. You've got to know, could history repeat itself? And that is what we are going to address in this video, because quite frankly, UBS believes this carry trade we talked about a couple days ago is only, quote, 50% unwound, which means we may have another Black Monday ahead of us. In this video, I'm going to address why this Black Monday happened. And I'm not going to explain the carry trade because we already did that in the last video. I'm going to explain specifically why the United States stock market was not able to stop the bleeding. As a result, it doesn't even matter if it's the Japanese carry trade that collapses or something else falling over. This stock market here in the United States, as well as elsewhere throughout the world, is on fragile foundations. And in this video, I'm going to explain why. But first, before we talk about the stock market, you must understand a tinderbox that exists right now in the Middle East. And no, I'm not making a reference to the fact that it's going to be 107 degrees outside in Iran tomorrow. I'm referencing the fact that Iran is using that tinderbox as an excuse to close government buildings and banks tomorrow. No mention of closing schools, just government buildings and banks, which, interestingly, could be the perfect targets for a counterattack or preemptive strike from Israel. This comes after the State Department argues the United States just had a base struck in Iraq where several U.S. service members once again have been injured. We have been attacked on our bases over 200 times and have not responded to these Iranian-backed rebels. A lot of this might change, as Iran is expected to invade Israel soon. In fact, Iran just got its shipment from Russia of air defense munitions and weaponry. Iran may be preparing to strike and preparing its countermeasures. But this video isn't about that tinderbox. This video is about the rest of the fragility of the US stock market and whether or not we are trending towards a recession. We're going to dive into earnings, what professionals believe, and the Federal Reserve. First, Cathie Wood, who studies a lot of microeconomics, believes we are almost certainly in a recession now. T.S. Lombard isn't so convinced. T.S. Lombard argues that this rut will blow over, that this carry trade might be one and done because the Federal Reserve has the right tools this time to fight a recession. However, they do acknowledge that Powell could mess this up. But what's there to mess up if this is Japan leading to potential crisis in the U.S. stock market? Well, the reality is the U.S. stock market is so fragile, not just because of what's happening in Japan and selling pressure, what's happening in geopolitics, but what's happening in the underlying realm of the U.S. consumer and U.S. businesses. T.S. Lombard says bouts of volatility are usually over between 5 to 6 weeks after a Monday like we saw, which suggests we still have a very fragile 5 to 6 weeks of pain potentially ahead of us. They suggest that recession is not an option for the Federal Reserve, and they'll bail us out. But this is where a lot of people disagree. They argue that the election is likely to extend that volatility for the next 13 weeks, double the usual volatility you would get after a Black Monday. This idea also that a recession is not an option is also a giant trap. Remember this. It took the Federal Reserve 2.5 years to bail us out of the dot-com bubble. It took the Federal Reserve 6 to 10 months, it's because we had a double bottom, that's why there's a range, to fully bail us out in the Great Recession of 2008. Only during COVID did the Federal Reserve respond rapidly, but then they contributed to the highest inflation we've seen in the last 40 years, which high inflation is known to destroy countries. Ironically, recessions are considered healthy. They don't destroy countries. Inflation does. This leads a lot to say that the Federal Reserve will not make the same mistake again. So unless you think this time is different, the Federal Reserve is probably likely to wait until the very last moment to capitulate and fully bail us out if we have another Japanese crisis or for whatever reason a stock market sell-off, especially in the face of stronger ISM services data that we just got on Monday, suggesting prices are potentially rising rather than contracting. This makes the stock market quite risky. In fact, T.S. Lombard goes as far as suggesting that investors today, during these periods of volatility, like what we saw as a result of Japan, will lead investors to do something known as selling into strength. This means they won't necessarily sell on the day that everybody is panicking, but instead, something much like what we saw today will happen. There are two very important things that happen today, and you should pay attention to these, maybe even put a sticky note on your computer. First thing that happened, we had the NASDAQ recover. After we have a Thursday sell-off, a Friday sell-off, and a Monday sell-off, the vast majority of the time, and on average, we are green on the following Tuesday. It's a phenomenon called Bounce Back Tuesday. It's not a big deal. It's very highly predicted. And a Bounce Back Tuesday today in the NASDAQ occurred with volume that was really light. In other words, the NASDAQ 100 Technologies Index rose almost 2.5% at one point, actually slightly more, on very, very low volume, which suggests people are slowly nibbling, buying. And then what happened right around an hour before the closing bell? Volume increased and the stock gave up the index gave up over 1.5%. A massive movement in the span of an hour for the NASDAQ 100. This is likely because institutional investors, as T.S. Lombard warns, sold the strength. This is really bad because when investors sell the strength, it means you don't have buyers. And when you don't have buyers, you exacerbate the potential of another Japan really destroying our stock market. But there's another thing that happened. Today, we had Super Microcomputer that reported earnings. And Super Microcomputers, as soon as their revenue beat and guidance came out, skyrocketed from about $616 all the way up to $729. That is an increase of over 18.1%. It's an insane explosion. And then just like T.S. Lombard warned us, almost as if on cue, investors sold the strength. Take a look what happened afterwards. After that run-up, the stock collapsed significantly lower than where it was, now sitting around $540, which is substantially lower than where we were at the closing. It's 12.3% lower. So in other words, we literally had a 30% swing in this stock from top to bottom in after hours because we got strength and we sold it off. And what's sad about this company is if you actually zoom out and you look at this company broadly, the company is already down from $1,229 now all the way down to $540. Ask yourself how scary that is for a moment by doing the math on that. $540 divided by $1,229 is a 56% drop in just one stock in a matter of less than 4 months, which is less than the time it usually takes for the Federal Reserve to bail us out of a recession. So if you think the recession is over because the stock market corrected 15% and today the stock market was almost up 1%, you might be sadly mistaken. We might be experiencing a dead cat bounce, which is kind of like when you drop a cat that's dead, it bounces up off the floor. You get a little bit back. And this isn't to be morbid. It's just to say it's very normal, even in a recession, to have green days. And we understand this. In fact, because of this crash that happened on Monday and because of the fear that we have that another crash is going to happen like this, we are going into almost every single day with shorts at the end of the day, just in case some crazy stuff happens overnight. We did that on Friday. And when I say we, I shout it out in my course member live streams. I don't say that you should copy exactly what I do. I just give you perspective. But what I want you to know is on Friday, I went in with a 30-cent option. I spent about $30,000 on an option, and that turned into roughly $120,000. It was actually $118,000. A massive gain on one contract that I was using to hedge my portfolio. Now, I don't encourage you copy me. I can't guarantee you're always going to make money off every single trade that I make. But a lot of my course members, they say, Kevin, you give perspective that other people don't see until it's too late. And if you want that perspective, make sure you join us in the Stocks and Psychology of Money group. All you have to do is go to meetkevin.com. It is our sponsor for this video. That's right. I'm my own sponsor for this video. And I'd appreciate it if you joined. We've got a flash sale going right now because a lot of people have been asking for a coupon to get in. So check it out before that flash sale ends. We expect to end it within the next 24 hours, maybe 30 hours. It just sort of depends on when we get to it because a lot of people have been asking. Look at this nice email I got as well. Somebody wrote here, I was just reading the Discord notices from today, and Kevin, I have to say, Kevin is often more right than not in the market. Only constructive criticism I have for him is he is just early to his moves. I've been an avid watcher with him since early 2020, and he has a nose for the moves before the market does. Anyway, these are the sort of things that course members say. Now, no guarantees again, but do check it out. Link down below. For now, we got to understand, why could selling the strength lead to potentially another Japanese sell-off? Well, again, we have another 50% to go in the yen trade. So, I mean, I'll give it to you straight on that one. If you just look up, and you could make this very, very easy on yourself, and it's just part of what you want to pay attention to. All you have to do is type into Google, yen to USD. That's YEN to USD. And I want you to track this. Go to the 5-day. When you go to the 5-day, you're going to do something very, very carefully. When you see this spike, expect the carry trade to send pain to America. And then you have to ask ourselves, are investors in America going to sell the rip, or are they going to keep buying the dip? Well, on Tuesday, the Japanese stock market recovered as the yen actually depreciated. But look what's happening now. It's appreciating again. So be careful. This spike in this carry trade is not over yet. Bounce back Tuesday may certainly have made it seem like this is one and done. My take is it's about to get worse. Now let's understand for a moment how things could get worse. First, consider super microcomputers. They announced a 10-for-1 stock split, and yes, they announced record revenue well above expectations, 18% over expectations, in fact. But their margins came in weak. Now, why would their margins come in weak? Well, I believe that their margins are coming in weak, and I'm going to tell you what actually happened because we heard about it in their earnings call. But I initially wrote that I believed their margins came in weak because you've got someone, or the market in general, demanding price cuts. And so Supermicro is propping up revenues because they want to send a growth signal to the market so they could get their stock back up from being down 50%. So, hey, let's prop up revenues by cutting prices. Cutting prices is bad because it destroys margin. And so what did we learn in their earnings call? Well, in their earnings call, they told us exactly that. They blamed a very large enterprise, high-quality, large-scale customer and said because of them, they had to lower margins. In other words, they had to offer them large discounts. This is really simple because it starts with the following. It's Amazon. We have a $10 billion contract with you. You need to cut your price 10% right now. Otherwise, we're canceling all of it and we're going somewhere else. Now, I'm being hyperbolic, but what power does Supermicro have to say no? Now, you might say, oh, they'll send it to somebody else. Oh, but what have manufacturers across all of America and Supermicro been doing? They have, as Supermicro said in their earnings call, quote, expanded supply. And their large customers know it, so they demand discounts because they can. And then investors sniff that out and they sell the rip. See, now they argue they have plenty of availability, they have plenty of product, and you might think their profit margin would guide back up, but no, they're having trouble getting it back up to where it was. They're going to work very hard, they say, to get it back up to the prior range. It's probably not going to happen. But this isn't just about super microcomputer. This is about how does selling the strength affect the entire market? Well, think about this for a moment. The way stock markets crash is somebody cuts spending. It could be as simple as CapEx spending pressures margins at super microcomputer. This is literally what we just saw. Then somebody cuts CapEx spending. Dell and Intel just did that after their stock dropped. Then jobs get cut, which increases margin to try to make the investors happy. But when jobs get cut, the consumer gets hit, which then creates a self-fulfilling doom loop of less consumption by consumers, and consumers are 70% of the economy. If AI spend fizzles, the one thing actually propping up jobs right now in spending disappears. Then the economy sees worse earnings, boom, the recession is in full swing, then try to deal with the other 50% of the Japanese carry trade. You're not going to be able to. It's going to be very disgusting. But hey, it's not just Supermicro who reported today, it's Airbnb. Ah, yes. Airbnb down 16.3%. They beat in the second quarter, but in the third quarter, they signaled, quote, softer outlook. They called it a broader moderation, softness due to slower lead times, some hesitancy they said they're seeing. They said this in their earnings call, by the way. I already went through these earnings calls. They said, we're starting to see hesitancy in how quickly people book. We've seen some movement in lead times, they say. People are booking later. They might be booking 1 to 2 weeks out. We're not seeing the 2-month bookouts anymore like we usually do. Then they're asked, hey, will you provide 2025 guidance? Nope. Will you provide Q4 guidance? Nope. What about Q3 guidance? Oh, that's lower. Not good. But that's just Airbnb. Well, what about TripAdvisor? Oh, yikes. You missed, and you're down 11.76%. Okay. But it can't just be the travel sector, can it? What about Celsius? Remember that energy drink that everybody went nuts over? By the way, we did a huge deep dive analysis in our course member live streams, and my course members were asking me, Kevin, why don't you invest in Celsius? And I said, there's too much competition in this space, and they're going to lose all their pricing power as soon as we go towards a recession. And so what did Celsius warn right here in their earnings call? They said that they saw their product in the convenience channel selling 43% more year over year earlier this year. But what just happened? Let me read it to you. We also began to feel the effects of the same macroeconomic factors that are pressuring same-store sales and affecting consumer purchasing habits. Just last week, one of the largest convenience chains noted their same-store sales were down more than 4%. So you went from 44% growth to now being down 4%. And this happened just last week, which would be the end of July, which is the same thing that Airbnb said, that, oh my gosh, we hit a wall in July. So all these earnings we're getting are like, oh, July's really good. Holy crap, what just happened in quarter 3? Again, this is why that carry trade is so impactful. Folks, the carry trade can happen again. The Japanese carry trade can happen again. Why? Because nobody wants to buy stocks right now. Okay, maybe people want to buy stocks, but they're fully deployed. Remember this, folks. This is so important right here. Cash on the sidelines for U.S. retail investors and investment firms. Subtitle: Aggregate investable funds as a percentage of equity market cap. Record low. We have not seen investable funds amongst households and investment organizations this low, quite frankly, since the dot-com bubble and COVID. In other words, people are out of moolah to buy the dip. So if there's no buyer, what happens? The order book collapses when you get a Japanese liquidator. That's why stocks collapse. And that's why it can happen again. Because weak earnings across the board. Look at this. After hours. Tesla down 2%, Redfin down 4%, Reddit down 4.8%, Rivian down 6.7%, TripAdvisor 12%, Airbnb 16%, Supermicro almost 13%, Nvidia 2%, NASDAQ 100 down 63%. Why is this happening? Because people are realizing the cracks of the consumer are serious. They're not getting better. Now, Celsius says, don't worry, we're going to keep growing and we're going to fight to regain the market share we lost. How are you going to do that? Oh, with better pricing and promotions. In other words, you're going to lower prices. That is called deflation, which is really good for the consumer, but not if you lose your job. Now, you might say, but Kevin, Upstart beat for Q2 and they gave a better guide for Q3. And that's true, they did. Upstart is up 18% in after hours. But what does Upstart do? Upstart helps you consolidate your debt. It's literally the last thing you want to be doing well because it's a lender. People are so out of freaking money that Upstart is doing well. Upstart, a stock that's currently trading at $28 when it once was trading for $401. This is the company people want to cheer over? It's a joke. It's a bad sign. So, what should really scare you? The selling pressure coming from CTAs. Now, a lot of people aren't familiar with this because a lot of people are like, but Kevin, what about all this money on the sidelines in money markets? A lot of that is called cash and cash equivalents on corporate balance sheets or bank balance sheets. These aren't investable funds. But what should scare you is the CTA cheat sheet brought to you by The Market Ear. Look at it here. CTAs, if the market is up over the next week, plan to sell $50 billion in total. If the market is flat, that's if the market's flat the next week. If it's up the next week, they plan to sell $33 billion. If the market is down, they plan to sell $77 billion. So in all cases over the next week, commodity trading advisors, which have a lot of equity exposure right now, are sellers. In the next month, if we're flat over the next month, they'll sell nearly $100 billion. And if we're down the next month, they'll sell $211 billion. If we're up, they'll buy just 40, which is one of the smallest amounts on this chart. Here's another way to visualize it. The upside right here is maybe 15%. But the downside is 15 to 45%. This is massive. So you have to ask yourself, do you want to be, if we're this little blue line, do you want to invest for this? Or do you want to protect yourself from this? Again, I don't want you to lose money and lose the potential on the upside. I really don't. Like, I want to be a bull and I want to say everything's going to the moon. But I don't want you to be the person that this happens to, and then you lose your job, and then you go bankrupt, and then you say, why didn't anyone warn me? Okay, fine, Kevin, fine. What else? What does Mike Wilson of Morgan Stanley have to say? Because I heard small caps are going to rally. Right, small caps. Well, I'll show you exactly what Mike Wilson has to say. Right here in his latest piece. Mike Wilson says, you should be careful and you should get defensive. He says that the consumer buoyed growth last year and fended off that hard landing. But if consumption is now fading more than expected, investors should be very careful. Because if we get a further deterioration in growth that materializes beyond just an expectations miss, valuations would likely be more broadly challenged. In other words, stonk down. And he argues that you should be careful investing in small caps because they are the most economically sensitive. But this is not the only thing he suggests. He argues the Fed is not going to come bail you out. The Fed is prone not to overreact at this point. And we'll have more to talk about at the Fed in just a moment. But what I'd like you to see is the following first. I actually gave a preview of this because I mentioned this on Twitter. But take a look at this right here. This is the spread, in other words, the difference between the 2-year Treasury yield and the Federal Reserve Fed funds rate. That spread, that difference right now sits at about negative 163 at the time the screenshot was taken. It's probably about 144-ish right now, so it's tightened a little bit. But the point is, the last times we were at these levels, let's just say, were not very happy times. Look on that chart and see if you can spot when we were last at those levels. And then I'm going to give you the cheat sheet by showing you my Twitter. Follow me there if you haven't yet. Oh, and I'm blurry. At RealMeatKevin. Take a look at this. The last time this level happened was June of '89, right before the 1990 recession. January of 2021, right before the dot-com recession. And December of 2007, right before the 2008 recession. That's not good. Wilson suggests we should be very careful because the past several weeks have been more about degrossing than anything else. In fact, he says it right here. Now, what does that mean? Well, degrossing is a fancy way of saying de-risking. He even says here, as regular readers know, we have remained steadfast in our view that small caps, so smaller companies, are not the place to be in a late cycle economic environment, like today, going into the first cut. In other words, be careful with smaller companies. The micro data is warning us that the forward trend is weaker. This is the same thing that Cathie Wood argues. This is not an isolated slowdown, he says. Restaurants, airlines, hotels, autos, credit card companies, they're all warning of a slowdown with the exception of some of the wealthiest consumers. But this makes sense. They got money to burn. Now, the next thing that Mike Wilson argues is really dangerous is that the market last capped out on July 11th, which was the same day that we actually had a CPI data release. And what he thought was really interesting about this was low inflation all of a sudden became bad news. That's because slowing inflation, while it's supposed to be good news, is actually signaling that earnings are going to come in weaker and that pricing power is waning. The PP is getting small. The PP is fading, and that's not good. We like big PP around here. In fact, take a look at this picture. This photo right here will show you exactly
Little PP.
all of these 12 industries, with the exception of clothing and footwear, which I found weird because I don't think that these are actually going to keep doing that well. With the exception of clothing and footwear, every single sector has slowing or falling pricing power, and it's very, very bad. Now, something else that you should be paying attention to is what happened the last time the SOM rule was triggered. In fact, what has happened historically every single time the SOM rule has triggered? Well, we have data on this. In fact, it's right here. History shows when the SOM rule is triggered and unemployment rises by 50 basis points, we should expect it to rise a full 2%. In fact, the history is right here. Look at all of these different years where when the SOM rule has triggered, we have seen unemployment rise by an additional, there I'll hide myself for a second, by an additional 2%. Well, 1 to 2%. Now you might ask yourself, but Kevin, what about that question mark you drew right there on that 1 year? There was an exception to this rule that unemployment skyrockets basically after the SOM rule is triggered. It happened in all of these years, all years that weren't exactly particularly juicy. Well, there was a reason for that. And I'm going to give you the rationale on it and the history on it, and then you can decide what the SOM rule being triggered within the last week means for us going forward. In 1959, which is where that line was, that one line that's under there, where unemployment actually fell after the SOM rule was triggered, something very unique happened. 1959 was a second trigger. It triggered after the 1957 trigger, during which unemployment did rise those 200 basis points. The market fell 17.4%, like the Dow Jones Industrial, in 25 months from the 1956 peak. You literally bled for 2 years in the stock market. And that's the Dow. That means a lot of the components got hit even harder. The Fed then decided to drastically cut rates from 3.5% to 0.63%. But then they ignited inflation. They didn't even overignite inflation. They barely ignited inflation. But because they started igniting inflation by cutting rapidly, they actually raised rates back to 4%, triggered the Somme rule again in 1959, and caused a second recession in 1960, where the market then declined 15.7% in 10 months. This paved the way for the 1970s, where the Federal Reserve reacted in up and down patterns, leading to the lack of confidence at the Federal Reserve. And we ended up getting a runaway of inflation. This is a really critical note, because if the Fed screws this up again with inflation, whatever little faith people have left in the Fed will lead the Fed to absolutely collapse markets again in a stagflation scenario. The Fed cannot afford to do that. The Fed cannot afford to save the day too early. Inflation is unforgivable. They cannot reignite inflation. So they won't have an emergency cut, in my opinion, and they'll probably cut rates too late. They don't want to repeat the mistakes of the late 50s or the 70s. People ask, oh, but the Fed wants to avoid a recession. You have to ask yourself, what does the Fed want more? To beat inflation or to avoid a recession? Most people are going to say the Fed wants to avoid a recession, but it's actually the wrong answer. A recession is curing. A recession kills inflation. It helps them. A recession crushes businesses that should fail. A recession cleans out existing businesses. A recession creates healthy foundations. The Fed knows this. They're economists. They're theorists. They study this and they say, yes, recessions are actually good. Although they could be painful, we'll cut rates when we need to. Well, if we go into a recession, you don't want to invest again until they capitulate. But reigniting inflation is not an option here. Now, I know some people say, but Kevin, we might have a soft landing. And they refer to the 1995 era, where the Dow Jones rose 2.2x from its 1995 level, its pre-dot-com peak. But to this I say, the NASDAQ is already up 1.93x from Q4 2022. Now, I understand I'm using a different index. But the point is, we have already seen a substantial run in mega caps, the Mag 7, and some of the biggest businesses in our world today, which were measured then by the Dow and are more heavily measured today by the NASDAQ. So you might say, I don't know, Kevin, this time's different. We've got another 2x ahead of us. But unfortunately, it seems like the data doesn't agree. In fact, Bank of America goes as far as suggesting that recent growth is slowing faster than expected. They also say, and so do others, say that investors are becoming too greedy, relying on the assumption that the Federal Reserve will bail them out the next time there's a Japan oopsies. In fact, Rabobank went as far as saying, when things flip bad, we demand rate cuts. Heads, I win. Tails, I lose. But taking the froth out of stocks is exactly what the Fed wants, they say. This then loops us back to Iran, suggesting an attack on Israel is imminent, which, unfortunately, Rabobank says a war with the axis of resistance could lead to a volatile oil shock. So then you'll have a shock in our economy, a recession, an oil shock, and potentially war. This isn't just about Japan, it's the fact that nobody wants to buy right now because they already bought. And this is why you're seeing profit taking, and why at the very least between now and the election, you should probably expect profit taking to continue. So, could there be another sell-off on another one of these Japanese carry trades? The answer is no if you think there are buyers. If there are a lack of buyers again, the answer is yes. Then you have to ask yourself, what is investable cash right now? It's very low. And so where do I stand on the bear bull scale? I stand at a 2.5, just pretty bearish. I'm not full dirty bear yet, but I'm starting to get there. Unfortunately, we may be trending right towards a recession, and I have no faith that the Federal Reserve will respond early, because when you study history, you see that the Federal Reserve has screwed up every time they respond too early. And besides, if they cause inflation, everyone will hate the Fed. If they cause a recession and the Fed comes in on their white knight and capitulates and cuts rates to zero and starts QE again, they'll love the Fed. The Fed only loses by cutting too early. And once you recognize that, you'll probably become one of the sell the rippers, and you'll start protecting your portfolio. If you want more of my insights, make sure to use that flash sale we have on the programs on building your wealth. I wish you the best. This is a very scary time. And if you like this video, please consider subscribing. The last time I asked, y'all helped me get to 2 million subscribers, and I really appreciate and thank you for that. Just know this video took 2 days of research to put together for all of you, and I do it because A, I love it, and B, I'm really worried there's going to be a massive amount of job loss. I would rather be wrong. I would rather people not lose their jobs, the stock market boom, and everybody be happy. But I don't want you to go into this unprepared. Thank you so much for watching. Goodbye, good luck, and we'll see you in the next one. Go to meetkevin.com to check out that coupon code, Aspiring Suit.
Not advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.